Hello and welcome to this market special from Business Today. I'm Udayan Mukherjee. With me is Aabha Bakaya and our guest for today, Andrew Holland, CEO of Avendus Capital. Andrew, good to talk to you after a long time. But it's been a bad market for nearly a year now. But where are we now in this bear market, you think? I mean, it's been pretty orderly so far as these things go. But do you see the prospect of things getting uglier as we get deeper into the year?
Well, first of all, Udayan and Aabha, it's a pleasure always, and takes me back to our old times. But so it's a pleasure for me. Thank you. Could it get uglier, Udayan? The answer is probably yes, and I think the reason behind that is that we're still into that tightening mode. For the central banks globally. And, we don't know what the unintended consequences of that might be. You've had liquidity, you could have streaming around for the last few years since COVID. So there could be some, things that have been hidden under the carpet, which we don't like once liquidity starts to dry up. And, if you look back at what happened in China, when they tightened in 2021, the outcome of that was obviously this big problem now in the property market. So maybe there's some unintended consequences. Maybe some of it's played out already, say in the crypto world, where we've seen obviously some big defaults there. But I'm still worried about the credit markets as the Fed reduces its balance sheet. And let's not just concentrate too much on the Fed. There's also Europe, which is really spiraling down into a recession. And if Mario Draghi does resign in Italy, then that will have other consequences for the bond markets in Europe. But the big message from Europe is that the powerhouse Germany is not the powerhouse anymore. So if that's faltering, the rest of Europe is probably going to feel a lot more downward swift from that. So that's the problem. And again, whilst we talk about central banks increasing rates, it's going to be different for each country. For the US, really inflation is a lot of it's in the housing market. So they really have to bring down the aggregate demand in housing. Say in India, ours is more food inflation. So we have to look at food inflation and energy inflation. Same for Europe. So I think every central bank will have its different approach to this, which will bring its own volatility and downward risks.
Now, when you speak about unintended consequences, Andrew, but is it the macro that you're worrying about, or do you think there is a micro event risk? Is that what you're alluding to? Because, if you look back in the day to 2008, the macro was bad, but it was a micro event like Lehman, which actually led to the undoing of the market. Do you think as central banks tighten further and the growth concerns become larger, there could be any micro event which is lurking there, which could come as a surprise, which the market has not priced in already?
So I think there's two parts to that, Dave. One is, first of all, this is an economic recession. And probably me and you talked about this in 2000, but I don't think many people remember what an economic recession is really all about. So that's the first point. The second point is 2008 was a financial economic downturn, not an economic recession, although it caused some problems in there. So I think when the Fed increases rates, it's really the credit markets, which you could have some problems with. And that's where the micro risk comes from. And obviously, if that then spills over to the bond markets and the currency markets, you get further volatility. And that's where the unintended consequences happen. And of course, when that further exacerbates the problem about economic growth, and therefore earnings forecasts, which are still very high, in my opinion, globally, will have to be reduced even further. So that's what the market is probably not pricing in at the moment. I think the market's pricing in all the things that you've talked about previously in terms of high inflation, what central banks are going to do. But these unintended consequences, I don't think the market's yet pricing in. It's more the Goldilocks scenario, but for the time being.
No, you made a very important distinction between an economic recession and a financial market recession. Given that this is more macro and a classic economic recession in that sense, How long do you see this bear market lasting? Having seen a couple of these in the past, from a time frame point of view, which kind of innings are we in now, you would say?
I actually think, the market from the days that we remember actually act a lot quicker in terms of pricing in events. So I think what's going to happen is our view is that by the end of this calendar year, by December of this year, we'll be talking more about deflation because the economic downturn will be very quick. Therefore, the market will probably start to price in when the Fed stops or pauses in terms of interest rate hikes. So we think that will be October of this year. So that's what the market will try to price in from the second half of this year or the back end of this year. And when that happens, Udayan, that the Fed goes on pause, two things I think will happen. One, the dollar will start to weaken, and that will bring the risk on trade back to assets, including emerging markets. And I think India stands out in terms of our own economic growth. So I will see foreign investors come back by probably the back end of the year into 2023. So that's the more positive view we have, because we're thinking about deflation, not inflation, by the end of the year.
Sure. So, Andrew, in the light of this and in the current context, I mean, firstly, India seems to still be faring okay. We did see some numbers come in last week suggesting that perhaps retail interest is now looking a little shaky. Does that change the scenario for India at all in your books?
No, I think the retail, you're talking about the retail investor, Aabha, right? In terms of the retail investor, it's been pretty resilient, actually. It's been, I suppose, surprising to us all. In that respect, I think, though, one of the things that was mentioned at the beginning is that no one's made any money in the past. I think probably less year and a half now, and particularly if you're below the kind of index, you're definitely losing money. So I think patience will run out, particularly if there's another downturn in the market. I think that will shake out quite a number of retail investors. From where they are today in terms of doing their kind of investments. I think what we've seen in the last 6 months, depending on kind of which tweets you look at, a lot of people were making money in options and trading, and that's really kind of disappeared now. I think people have lost quite a bit of money on both accounts, and I think the message went from I can't, I'm making lots of money to when will the market stop falling. So I think that's where we've moved to, which isn't a bad place to be. But I think any more downturn in the markets will probably have these investors, run to the shelters.
From an absolute point of view, Andrew, how much downside do you see to this market? Because, I mean, as I was saying earlier, this has been fairly orderly. Of course, mid caps have fallen 30% in many cases. But if you look at the headline index, which is still a very large part of the overall market cap of India, but the fall is barely 15-18%, which for a bear market is very low. Do you see a possibility of another 10-15% kind of an index downside before the year is out, or before we get to that October period you're talking about?
So if we had another down leg for whatever reason, again, and let's say that takes global markets down, our feeling is that the S&P is probably maybe 10%. Could see another 10% fall. We think our market could probably take a 5% fall. So we're around that 15,000 Nifty level. Now, obviously, they'll all be, it could overshoot on the downside as well. But I think anything towards 15,000 is a good time to deploying cash. And one of the things we've been doing throughout the year and saying is that expect volatility, and therefore cash as an asset class is not a bad place to be when you have a lot of volatility. It's always good to have money ready to go back into the markets rather than taking volatility in the short term. So I think we're moving past that phase. There could be, as I said, one down leg to the markets if some of those unintended consequences we talked about do appear. But if not, we will be in 6 months' time. I think we'll be higher than we are today. Okay,
and where do you stand on the two legs of the market which has soaked up the brunt of the FII selling over the last year? If you look at the banks and IT, but that's where the big holdings for FIIs have been traditionally, and that's where the technical problems have been, because there's been constant supply of paper for both those sectors as FIIs unload stock. By what point do you think that these become attractive once again, having seen the bulk of the FI selling behind them already?
So IT is a little bit more tricky, I would say, Dan, because it's a nice place to hide at the moment, or should be, given the rupee depreciation. But you're really coming off a fact that the growth stocks in the US, the IT stocks there are really under pressure, and I think we're going to see more margin pressure there and possible downgrades to earnings. So whilst the IT sector benefited from all this growth globally in terms of the tech companies, obviously sentiment will work against it in the short term if that was to happen. So I think the best way to play, between the two, is the only place I want to kind of invest in when deflation comes along. It's the banking sector. Now, it's all about timing, right? So I think it's the next few months which we'll get that timing for the banking sector. But that's the best way to play deflation.
Okay. Would you say the prudent strategy at this time, Andrew, would be to stick with the safer bet, particularly now with revised valuations, rather than exploring for those nuggets in the broader markets?
So I think there's a few themes. I think, first of all, there's the deflation theme, which therefore I'd be looking at, as I said, the banking sector. But I'd look at all those sectors which have had higher input prices. So the auto sector, for example, we've got a lot of tailwinds going forward. And that's another sector. Same with the FMCG sector. That's a consumer discretionary. Those are the kind of deflation themes I'd be playing going forward. But, one of the questions is, what's going to get global growth picking up again in 2023? And I think that's going to be a CapEx cycle picking up, not just from governments on the normal roads and bridges, but by governments and companies in those sectors where they've obviously seen security risks. So, for example, semiconductors. We're starting to see companies come to India to start putting up semiconductor plants. So how do you play that? It's not the normal L&Ts and BHLs. It's more the specialized companies, who can do smart factories, smart offices. So the ABBs, the Siemens of this world are going to be the beneficiaries of this. So I think there's going to be a number of themes that play out on the infrastructure side, but not necessarily your traditional roads and bridges. And I think that's where you're going to see the pickup in global growth in 2023.
Now, the worrying question, Andrew, and one hates to ask it, but the last time the world had a serious inflation problem and the central bank started to attack it, they didn't get behind this problem for many, many years. We've lived in an era of the last 15 years where cycles have got compressed, and we are used to bear markets of 1 year, and then some curative thing happens, and then markets start on an up cycle once again. What is the probability that this takes not a few quarters or months, but is actually a much longer battle, and markets do not rebound and refind growth as easily as everyone or we are talking about just next year? What is the time risk of this cycle playing out?
That's a great question, and it's one which I think the markets and myself will continue to grapple with in terms of that exact timing. But there's two things on this. One is the oil price. Now we can talk about Russia and Ukraine. Our feeling is that that there will be at some point over the next 3 months or so some move towards kind of a treaty or some kind of peace between Ukraine and Russia. And obviously that would have a big impact on the oil price going further down from here. And the reason I'm saying that is that, with the problems that you're seeing in Germany and elsewhere in Europe, and the fact that the UK is going to get a new prime minister who might not be as pro Ukraine as Boris Johnson was, maybe there'll be a move towards brokering some peace there, which obviously, if you look at the maps, you can see where Russia is today from where it was at 2-3 months ago. It's really the areas that they wanted to take, which is Donbass and Luhansk, is where they're concentrating their efforts at the moment. So maybe just there'll be a brokering a piece there, just say take what you have and we'll keep the rest of Ukraine, and that will help Europe. That's one thing. I think the second factor is that whilst I think demand will fall very quickly, because if I speak to any one of my friends in the UK or Europe, they're just spending their money on higher food bills, higher energy prices, and soon to be higher mortgage costs. So their disposable income's falling very, very quickly. And that's why you'll see that even though the Fed might not have to increase rates so much to fight inflation, the demand destruction because of people's disposable income falling will be the factor that helps them on the fight for inflation. I don't think it's going to be that the Fed's increasing rates is going to have that much impact until it hits the housing market, which is a big component of US inflation.
So as a fund manager, what are the top 4 sectors you're hiding in or biding time around till this phase, the bad phase ends? I mean, if you look at your top 10 holdings broadly, what could it be classified around in the top 3 or 4 sectors?
So we've been, throughout the year keeping quite a lot of cash a day, and to be honest, and that's played out well for us. As a hedge fund, obviously we can hedge our exposures as well. So we've had very high hedges over the last 6 months as well. So not really committing too much to the markets. But as I say, we're moving more and more towards the deflation trade, which is banking, autos, consumer discretionary, and FMCG. Those are the 4 sectors which we have more of a constructive approach at the moment. And on the hedging side, obviously, if we think about deflation, then at some point, it has been happening anyway. You've seen, metals and oils, start to kind of fall quite significantly because of the fall in the prices there. So that's how we've been manoeuvring in the last 6 months. But it's been a tough 6 months.
All right. Andrew, we've kick-started earnings, of course. The latest lot when it comes to IT is out. What are the indicators you're picking up from that this time?
I mean, from the commentary, it's still, I think analysts and companies are always late to tell us when things are starting to kind of slow down. But it's evident from the margin pressure that you're seeing in the IT sector. So I can only see it getting under more pressure going forward as we kind of flirt towards, particularly in the US recession, and companies, will start to kind of, bring back their expenditure plans in the short term. That's bound to happen. So I think for the IT sector, there's more headwinds than there are tailwinds, but it's more sentiment based as well. Because if you have a bad earnings season in the tech industry in the US and downgrades, then this will have a negative impact on the IT sector here. So whilst it's usually a place to hide in, I think at this point, I'd rather be looking at, again, the deflation trade going forward.
Finally, Andrew, I was reading a brokerage report from a global house a few weeks ago, and they had a very nice line. I mean, they said, we are not at the stage where we can talk about what is the trigger for the next bull market. It's too early to start talking about all of that. Can you think beyond this to what could be the genesis of the next bull market, or is the picture really too clouded to get as optimistic as that?
I think it depends on where you are. I think developed markets are going to struggle at least for another year. But if we're correct in the fact that the Fed goes on pause from October and that deflation trade starts to play out, then the risk on trade will come back to emerging markets, because that's where your growth is going to be. I mean, China and India, China has its own problems we know at the moment. But that's where the growth is going to be over the next decade. So I do believe that investors will come back to emerging markets, and India will be one of the standouts because of that. So what I'm trying to say is that there might be bull markets within different markets. It doesn't necessarily have to be a global bull market for India to perform well. And that's what I think will happen over the next 1 year. But I think for the next bull market to happen, interest rates will have to stabilize at around, maybe at 75 to 100 basis points higher than where we are today. but the global capex cycle, which I mentioned before, starting to materialize, because that's going to be the driver of global growth going forward.
Andrew, it's been great talking to you and good catching up after a long time. Thank you very much for your time today.
My pleasure. Thank you.
If you like the video, do like, comment, share and subscribe.